I want to start by talking a little bit about what finance is and how I got interested in it, because I think it's often helpful in order to motivate a subject to get a sense of how somebody else decided to choose this as a profession. To do that, I have to go back a little bit and give you some background about my own educational experiences. So let me start by mentioning that I've been at MIT for the past 20 years and been in the finance group all that time. Before that, I taught at the Wharton School for 4 years. And before that, I got my PhD in economics from Harvard University, and then graduated in 1980 from Yale, also majoring in economics. And during that time, I've learned an enormous amount, both about finance and the real world. But one of the things that I keep coming back to is the fact that the finance field is almost unique in how it applies to practical management problems. And what I'm going to try to do over the next 13 weeks is to convince you of the fact that finance is, in fact, the most important subject that you'll ever encounter. That, in fact, finance is at the core of everything that you will ever do in business and in management. Now, that's a tall order, I recognize. And I suspect that some of you are quite skeptical about the role that finance might play in your own career objectives. And I know many of you have very different career objectives. And I'm not even trying to convince all of you to go into a career in finance. But I am trying to convince all of you that finance is really the lifeblood and the basic lingua franca of all of business. And that's one of the reasons why finance is such an important subject. Now, before I begin, let me ask you a question. How many people have had no finance background whatsoever? Well, that's great. I look forward to a challenge. But the other reason it's great is I have to tell you that it's a real privilege for me to be here in front of you to tell you about finance for the very first time. And it reminds me a little bit of my younger son, who is an extraordinarily fussy eater. He's 8 years old now, but ever since he was born, he had some allergies, and he just refused to eat most of everything. In fact, my wife often say that my younger son is a vegetarian, except he doesn't eat vegetables. So he's an incredibly fussy eater, and somehow when he was 1 year old, he saw my older son eating an ice cream cone and figured that that's something he ought to try. How he figured that out, I don't know, but he tasted it for the very first time, and you could see his face change in about 4 seconds from disgust to curiosity to absolute, enthrallment with the taste and feel of ice cream. He just loved it thereafter. That's one of his major food groups now, it's ice cream. And so I feel privileged to be able to share that experience here, in the sense that once you get a taste of finance, I think you're going to be incredibly excited and enthralled by the subject, because it's one of the few subjects, in fact, it's the only subject that I've encountered, that is both rigorous, it's extraordinarily challenging from a research and intellectual perspective, and at the end of the day, it's extremely practical. In fact, I would say it's indispensable for financial management. I want to start with a little bit of motivation, and then talk about the dramatis personae. These are the cast of characters that we're going to be focusing on over the next 13 weeks. And then I'm going to lay out the fundamental challenges of financial analysis. It turns out there are only two. There are only two challenges in financial analysis. And once you figure both of those out, you're done. So if by chance you can figure that out before the end of the class, you don't need to come back for the rest of the lectures. Then I'm going to turn to providing you with a framework for thinking about these financial challenges. To me, it's very important to have a framework to start with, because I like to organize my thoughts into things that I know and things that I don't know, and of the things that I know, how did it relate to the stuff that I already knew or thought I knew? So I want to give you a sense of that kind of framework to think about financial analysis up front. You probably won't fully appreciate it at this point, but sometime over the next 13 weeks, you will get it. And so I want to give that to you so that you can start thinking about it subconsciously, unconsciously, and then eventually you will understand how all the pieces fit together. I then want to talk about the importance of two aspects of financial analysis that make finance different from every other discipline you will ever encounter here at MIT and elsewhere. And that is time and risk. Without those two factors, it turns out that finance is actually done. In other words, there's no real research challenges, no open questions left once you eliminate time and risk. Put it another way, the only reason that there exists a finance department and finance faculty and finance journals and a finance industry, the only reason is because of time and risk. So I'm going to come back to that. Then I'm going to conclude by giving you the 6 basic principles of finance. These are principles that you will encounter in all of your finance courses for the rest of your stay at MIT and elsewhere. These are the ideas, the fundamental ideas that have shaped financial markets and that are at the root cause of all of the financial market innovations, as well as all of the financial market crises that we've seen, including what's been going on over the last several months in the subprime mortgage market. In fact, we're going to talk about the subprime mortgage problems after we cover fixed income securities. Right now, I suspect most of you know that there's something going on, know that it's bad stuff, but you don't know why, how, where, when, and what to do about it. Well, in about 5 lectures, you will. It's not complicated, but it's different from anything that you've ever encountered. And in fact, financial analysis, I suspect, is different from anything most of you have ever encountered. I'm hoping that by the end of the course, it will change the way you think about everything. And again, I recognize that that's a tall order, but you tell me 13 weeks from now whether or not I've delivered. All right, let me start with some motivation about why you might want to study finance and why finance is so important. And I've always found that with motivation, it's really best to do it in a personal way. That is, to try to find an individual or a group of individuals that personify a particular discipline or endeavor. And so there are 3 people that I'd like to introduce you to. I suspect you'll know at least 2 out of the 3, but my guess is you won't know all of them. The first person, before I do that, I want to introduce a very simple definition of what finance is. So this is the very first equation that you'll ever see in this course, and there'll be many others, of course. But the first expression of exactly what is finance is this. Finance is simply equal to mathematics plus money. Now, that suggests that mathematics as a discipline is equal to finance without the money, but really that's not, that's not my point. Although it's true, by the way, that's not my point. My point is that finance is the study, the systematic and disciplined study of financial transactions, of money. Now, when you see this, you might think, well, gee, I don't really have a strong math background. Maybe I'm in the wrong place or the wrong class. And I want to explain to you that that's completely inaccurate and inappropriate. When I say mathematics, I'm actually talking about a very wide range of mathematics. Everything from the extraordinarily complex and profound to the extremely pedestrian and obvious. So literally, the range from differential geometry and partial differential equations on one end of the spectrum to arithmetic and high school algebra at the other end of the spectrum. Now, since this is an introductory finance class, I assume that you know nothing. What I mean by that is I assume that there are no prerequisites that you have other than what it took for you to get into here, which is pretty substantial, by the way. Congratulations to all of you for getting in. But we're not requiring that you have any background in quantitative analysis, computers, upper-level mathematics. So when I say finance is equal to mathematics plus money, there's a variety of kinds of mathematics that could be appropriate for creating an extraordinarily profitable career in this industry. And now, here are the 3 examples. Anybody know who James Simons is? Who is he? You know about Renaissance Technologies. Do you know what James Simons did before he started Renaissance Technologies? Yeah. He's a math professor. That's right. James Simons is a math professor. Well, was a math professor. In fact, He was quite a well-known math professor. When I first heard of him, it wasn't because of Renaissance Technologies, which is a hedge fund that he started about 15 or 20 years ago. James Simons was a differential geometer who for many years was the chairman of the math department at Stony Brook in New York. And he authored with S.S. Chern a particular field of study in differential geometry called Chern-Simons theory, which has subsequently proved to be extraordinarily useful in an area of physics known as string theory. Extraordinarily abstract. And Simons started a hedge fund about 20 years ago. And this is probably the single most successful hedge fund in the history of the industry in terms of its performance record. Over the course of 15 or 20 years, he's put together a track record that has literally beaten every other hedge fund manager's track record by a lot. So it's not just a little bit. He's just sort of way out there. He's the Michael Phelps of quantitative investment strategies. By the way, just to give you a sense of how successful he has been, in 2006, 2 years ago, it was reported by Institutional Investors Alpha magazine. This is a trade publication for the hedge fund industry. It was reported that James Simons was the single most highly paid hedge fund manager that year with a take-home pay of $1.7 billion. Now, that's not wealth, that's income. That was on his W-2. That was 1 year's compensation. And he did it. He did this by building a quantitative investment management company with 75 PhDs in mathematics, physics, computer science, and so on. And nobody knows what he does or how he does it. It's extraordinarily secret. But there's no doubt that he's incredibly successful. So that's one end of the spectrum. That kind of mathematics can make money and can be extraordinarily relevant financial analysis. Now, at the other end of the spectrum, we have this guy. You may have heard of him, Warren Buffett. He is currently the richest man on earth. In 2008, Forbes ranked him #1 in terms of wealth. At the time, February of 2008, he was worth $62 billion. In fact, in a private conversation, I was told that when Simons found out, he said, "Really? 62 billion? How did he get that? That's amazing." That's an extraordinary amount of wealth for an individual to put together. And what's extraordinary about it is how he did it. As many of you know, Warren Buffett is an investor based in Omaha, Nebraska. His office is probably smaller than many of the conference rooms here at Sloan. The number of people he has working for him, I suspect, is fewer than many of you who have done your startups or plan to. He's got an extraordinarily small staff. Mainly it's Charlie Munger and him and a couple of secretaries, and maybe a few accountants here and there, and lawyers, of course. But what he does is to read company prospectuses, income statements, balance sheets, and with literally high school arithmetic, he's built this incredible investment empire by looking at valuation. Simple accounting. Now I say simple accounting, but there's nothing simple about what he does. And so clearly he has certain skills that it also involve mathematics, but not the kind of mathematics that James Simons uses. And finally, the third individual that I'd like to introduce you to is this fellow, Jack Welch. Now, again, many of you know him or know of him. You know that he actually teaches a course here at Sloan. But you may not know that his PhD was actually in engineering. And he started out at General Electric in 1960, became CEO in 1981, and at that time, the revenues of General Electric was about $26 billion a year. So it was already a big and successful company. And Jack Welch took it over in 1981. At the time, there were 400,000 employees for General Electric. 5 years later, there were 300,000 employees at General Electric. He eliminated 100,000 jobs. That's one of the reasons why he developed the nickname Neutron Jack, because like a neutron bomb, he eliminated a huge segment of the population. But 5 years later, with 300,000 employees, he increased the market value of General Electric by several fold. And at the end of his tenure in 2001, 20 years later, General Electric's revenues was not 26 billion, it was 130 billion. He increased it by a factor of 4.5 over the course of 20 years. It's an extraordinary accomplishment for an individual. Now, why do I put him up here? It's because one of the things that Welch did at General Electric, one of the things that he was extraordinarily good at, was making good decisions about investments, making good decisions about costs, being able to understand the language of finance, despite the fact that he used none of his PhD skills in his job. He was an engineer by training, not a manager. He didn't go to management school, although he did a lot of executive education after his PhD. The reason that I give you these three casts of characters is because they are so different in what they do. They have such different backgrounds. They're all extraordinarily successful, but there's one thing in common. The thing in common is that they all understand innately, deeply, fundamentally, the language of finance. And what we're going to cover over the next 13 weeks are the very basics, things that they take for granted, things that they use on a daily basis to do their jobs. So it's not to say that if you do well in this course, you'll end up being one of these guys, but it's certainly a prerequisite, I would say. There's nobody that's been successful in business, truly successful, without having an understanding, at least an innate or instinctive understanding of the concepts that we're going to cover over the next 13 weeks. Now let me talk about the fundamental challenges of finance. I told you that there are only two, right? And here they are. There are two aspects of financial analysis that we're going to be focused on. The first is the valuation of assets. And the second is very simply the management of assets. That's it. That's all there is to it. Valuing and managing. And I can tell you exactly what the managing part is going to look like. Managing is going to involve figuring out which of two possibilities is more valuable. And then you know what? You take the more valuable option. That's it. That's all there is to it. Figuring out the value, that's going to be challenging. So we're going to take that first challenge to start with and try to understand valuation. I'm going to argue that all business decisions, any kind of business decision, involves those two challenges. Valuing something, and then once you value it, make a decision on what you want to do with that value, right? This is why I've argued that finance is the most important subject, because literally any business decision that you will ever engage in constitutes those two components, valuation and management. Now, valuation is going to be a challenge by itself because it's not at all clear what value we're talking about. In other words, what is value? Is water valuable? Well, life can't be sustained without it, at least carbon-based forms of life. So water is pretty valuable. But water is not that expensive, at least before Poland Springs came along. Now, what about diamonds? As far as I know, humans do not need diamonds to survive, and yet diamonds are extraordinarily expensive. There are certain gems that are invaluable. Now, how could that be? Clearly, we have to think more carefully about what we mean by value. And of course, once value is established, then management is relatively easy to do. Objectives plus valuations obviously leads to decisions. So once you tell me what you're trying to achieve, and then you value all the various different possibilities, then I can tell you what the right decision is. Pick the decision that is the most valuable for achieving the objectives that you want. Now, that doesn't really help a lot if we can't apply this to specific contexts and come up with specific value. So I want to hammer this home, and to do that, I want to talk about how it is that financial markets helps us establish value through the price discovery mechanism. Once we figure out valuation, we can then focus on management. And the first 2/3 of this class will be focused on valuation. The last 1/3 will be focused on taking those ideas and applying them to management contexts like capital budgeting and risk management. Okay? For valuation, the kind of questions that we're going to tackle are ones that implicitly we did in just a few minutes here. It's going to be how are financial assets valued versus how should they be valued, and is that always the same? Is it the case that financial assets are valued the way they should be valued, and what do we even mean by whether or not it should be valued in a way or not? Then the question is management. How much should I save or spend? That's a management question that all of you have to deal with at some point or another in your lives. What should I buy? What should I sell? When should I buy and sell it? And how should I finance the transaction? Those are the problems of financial analysis, plain and simple. These are problems that apply to Jack Welch, to James Simons, to Warren Buffett, and to you. And it applies to you not just from the corporate perspective, but from the personal perspective as well. Every one of you have to think about these issues on a daily basis. And so finance really is completely inclusive in the sense that it applies to virtually everything that you will ever encounter in life. Okay, to do that I have to go over the framework of financial analysis, and the starting point is accounting. Accounting is the language, the lexicon of finance, in that it's the beginning of how to measure economic concepts like profit and loss, and revenues and costs and so on. So while many of you may not have accounting backgrounds, you will learn a fair bit of accounting in this course just because you're going to have to in order to understand the material in the lectures. Okay? So you'll need to get familiar with the basic terms of accounting, and in particular, you're going to have to focus on two concepts that are probably alien to you: the notion of a stock and a flow. Now, when I say stock, I don't mean common stock or equities. I have a different term in mind. By stock, in this context, I mean the stock of assets, the level of assets. And by flow, I mean the rate of change of assets. You know, when I was in grad school, we started discussing this concept in the first day of macroeconomics, and then one of the students in the back of the room said, excuse me, professor, but isn't that just the distinction between a variable and its first derivative? And you know, the professor was a little bit taken aback and said, well, yes, that's right, but let me give you another way of thinking about it that's somewhat more intuitive, and that is, think about a bathtub and think about the faucet turned on and the water flowing into it. The stock is the level of the water. The flow is how fast the water is coming into the tub. And so after that explanation, the student still seemed confused. And so the professor said, you know what, some people find bathtubs intuitive, other people find derivatives intuitive. So to each his own. These two concepts are extraordinarily critical to financial analysis. And the accounting counterparts are nothing more than the balance sheet and the income statement. The balance sheet measures the stock of wealth of a company, what your assets are and what your claims on those assets or liabilities are. On the other hand, the flow of wealth into a company or out of a company is measured by the income statement. This tells you how much the company is making per unit time versus its losses. Okay? So the framework for financial analysis that we're going to be coming back to time and again is this framework of a corporation. A corporation has a certain set of assets. It's got claims on those assets, which are called liabilities. So this picture, this snapshot measures the level of the bathtub. But that's not enough to understand how a company is doing. You also have to look at the income statement, which tells you the sources of funds and the uses of funds over any time period, typically on a quarterly basis. So we're going to come back to this concept as the framework for financial analysis. And by the way, this is the sum total of the tools that Warren Buffett uses for analyzing his investments. That's it, believe it or not. Nothing fancier. So it's an incredibly powerful set of ideas if you know how to read it. Okay. That framework, when you think about it from a corporate financial decision perspective, involves making decisions at 5 points in time. Corporate financial decisions involve thinking about how to deal with cash raised from investors, how to think about cash invested in real assets, and how to deal with cash generated by operations, how much cash to reinvest, and how much cash you give back to your investors. So from this, you should get the idea that as a corporate financial officer, you are focused on cash, the flow of cash. In fact, cash you can think of as the lifeblood of a company. If you follow the cash, you will eventually hit upon every important aspect of a modern corporation's operations. And as a financial officer, you will be responsible for analyzing that flow. And as a decision maker, as a leader of a corporation, you're going to have to make decisions about that cash flow. Jack Welch uses the information to be able to make those decisions, but he doesn't just get those decisions prepackaged for him. He has to understand what those numbers mean, just like Warren Buffett. Now, the corporate financial decisions involved obviously have a variety of different components from a perspective of a career paths. From the management perspective, real investment decisions involve 2 and 3. So if you're thinking about investing in a new division or a new plant or getting involved in a new product area, you've got to focus on 2 and 3. On the other hand, if you're the chief financial officer and you're thinking about how should the company finance its operations, you're going to be focused on 1 and 4. If you're the board of directors and you're deciding how much to pay out to the shareholders, you're going to be thinking about 5. And if you're engaged in managing the risks of the corporation, you're going to be worried about 1 and 5. And ultimately, your objective as a shareholder and as a manager of this corporation is to do well by the owners. So your objective is to maximize shareholder wealth, and the framework that I've introduced is going to allow you to do that. Now, again, this may seem kind of theoretical to you, and I realize that, so I'm going to ask you to make this more personal. And to do that, I'm going to ask you to turn this into your own personal household financial decision-making framework. So I'd like you to take all of these ideas and literally apply them to yourself. Think about the cash flows that are flowing through your own life. There may not be that much right now since you're at school, but believe me, it will grow. So the household, this is you, sits in between real economic activities, in other words, your job, and financial assets and liabilities, which are all of the financial transactions that you deal with. So this cash flow process that I outlined for corporations, it works for you too. So there's cash raised from financial institutions, right? Like student loans or borrowing or home equity loans. There's cash invested in real assets. What's the biggest real asset that you are all investing in right now? Exactly, human capital, yourselves, your own education, okay? Cash generated by labor supply, well, obviously when you get a job, you're going to be generating cash. Cash consumed and reinvested in real assets, so consumed means beer or pretzels, whatever. And invested in real assets means you invested either in yourself or you invested in a home or your children. Those are real assets. Sometimes they're also real liabilities, but that's a separate issue. And finally, cash invested in financial assets. Most of you may not have a lot of financial assets at this point, but you actually have some, I suspect, 401k plans, retirement, Social Security. Those are financial assets that whether you know it or not, you're invested in. And so when you think about management, think about personal management. How are you managing yourself? you've got to think about real investment, consumption and financing, savings and investment, risk management, and obviously, what is your overall objective in life? And what you ought to be doing is, with that objective in mind, managing your real and financial assets to maximize the likelihood of achieving those objectives, right? So what I'm asking you to do is, I want you to take this course personally. I want you to take the ideas, every single idea that I mention, and whether I tell you to or not, for the next 13 weeks, I want you to take that idea and ask the question, how does that make my life better off? How can I use that in my own personal management activities to improve the kind of decisions that I'm making? Because if you could do that, if you learn how to do that instinctively, you will then take those ideas and apply them to management contexts in your career. And it'll make it much more likely that you'll get more out of this course than you otherwise might. Now, there are two other factors that I described that make financial analysis challenging. And those two factors are time and risk. I've argued before that without these two elements, finance is complete. There is no more research to be done. There's no more analysis to be done. And all of you probably will already be able to intuit a lot of the decisions that you're going to be forced to make. Because without time, and by time I mean decisions at different points in time, without time and without risk, financial decisions actually reduce to basic microeconomic analysis. If you've taken an undergraduate course in microeconomics, supply equal demand, well, you've learned all there is to learn about finance without time and risk. The only reason that finance is interesting, the only challenging aspects of what we do are because of time and risk. The fact that cash flows now are not the same as cash flows later, and that time flows in only one direction. In about 4 lectures, I'm going to give you an alternative proof of the theory of special relativity. And this proof will have to do with the fact that interest rates are non-negative. It turns out that there's a very deep philosophical connection between finance and physics that we're going to get to, okay? But this is something that you don't need to be a physicist to understand. In fact, I would argue that Warren Buffett, although he may not be able to articulate these principles, these are principles that are somehow inbred in his worldview. He knows that $1 today is not the same as $1 next year. And he also knows that $1 today without risk is not the same as $1 today with a little bit of risk, even a tiny little bit of risk. He knows that. And when we put these two together, we're going to get modern finance. There are 6 fundamental ideas that finance has come up with that really will change the way you think about the world. And you won't appreciate it today. I know that. But I want to put it into your subconscious today, because sometime your face will light up and you're going to get it one day. You're going to get it in the sense that you will understand at that point in time how these 6 principles can be used to make any financial decision that you need to make for the rest of your careers. The first principle is pretty obvious. There's no such thing as a free lunch. Actually, all of these principles are approximations to a much more complex truth. So if you really want to be strict about it, it should read, there may be free lunches on occasion, but there's no such thing as a free lunch program. There isn't systematic free lunches. You might be able to find 1 or 2 every now and then if you're lucky and if you work hard, but systematic transfers of wealth for no reason at all are unlikely. Second principle, other things equal, and this is a phrase that you'll hear economists utter all the time, and of course other things are never equal, but let's pretend that they are. Other things equal, individuals satisfy 3 characteristics. They prefer more money to less, that's often called non-satiation. They prefer money now to money later, and they prefer less risk to more risk when risk is defined properly. Now, I'd argue that these principles are, in fact, fairly universal. Not that you can't find exceptions every now and then for every individual, but by and large, over periods of time and over a large population, this is generally true. And if you don't believe me, or if you know people that don't satisfy these principles, please introduce them to me after class. I'd like to get to know them and do some business with them. Right? Principle 3, all agents act to further their own self-interest. Now, again, this is not to say that there aren't Mother Teresas out there, that there aren't people that care about the general welfare of the public. But economists, in their own unique and annoying way, have been able to redefine preferences to even argue that Mother Teresa is incredibly selfish because her utility function is the utility function of other people. And so by doing all this good, Mother Teresa was only furthering her own self-interests. Isn't she so selfish? Now, so in a way, when the economist defines preferences, they almost define it as a tautology. But finance makes economics practical in the sense that I'll describe in a few weeks exactly what kinds of preferences are actually embodied in decision making and why this principle is more often than not a pretty good approximation to a much more complex reality. Now, the last 3 principles, I'm not going to talk about in great detail because those really embody a much larger set of issues about economics and finance. We're going to talk about those 3 principles, but only in the last lecture, oddly enough. We're going to use them. We're going to use these principles, but in the last lecture, I'm going to question all of the framework that I've developed for you and show you where the holes are. For the first 13 weeks, I'm going to need you to willingly suspend your disbelief as we describe the relatively straightforward and standardized framework for thinking about financial problems. All right, thank you very much. We're out of time. We'll see you next Monday.